Hey guys, it's Simo from Investment Research. Welcome to our daily analysis. First of all, I invite to subscribe if you want. So we are on 28th in November. Now the stock is at 29.24. And honestly, I need to ask myself a tough question right now. After a 101% gain year to date, are we looking at a legitimate opportunity or are we chasing momentum at the worst possible time? Let me tell you what's keeping me up at night about this position, and by the end, you'll know exactly whether to take profits or hold on. So here's what I keep coming back to. The stock is trading at 29.24 today, up 2.63%. Sounds great, right? But wait, let me put this in perspective. We're just 10% below the all-time high of $32.73. The stock has doubled this year. Meanwhile, the S&P 500 is up maybe 15%, and even the Nasdaq only climbed around 22%. That means we're outperforming the market by 5x. Now I have to ask myself, does that make sense? Is this company really growing 5 times faster than the entire market, or have we gotten ahead of ourselves? Here's where I start getting uncomfortable. The stock is trading at a forward PE ratio of about 52 times earnings. 52 times, let me compare that to something we all know. Bank of America trades at 10 to 12 times earnings. JP Morgan, arguably the best run bank in America, trades at maybe 12 to 15 times. So I'm paying 52 times while traditional banks trade at 10 to 12 times. That's a 4 times premium. Why? Well, the bull case says it's because of growth. Traditional banks grow revenue at 3 to 5% per year. This company is growing at 35 to 38%. That's dramatically different, I'll admit that. But then I ask myself, what happens if that growth slows? What if we hit a recession and lending volumes drop? At 52 times earnings, there's zero room for error. One disappointing quarter, and this multiple could compress fast. That's what worries me. Now let me talk about what actually matters here, which is the lending operation. This is fundamentally a lending business that's trying to transform into a financial platform. Personal loans, student loan refinancing, mortgages, that's where the money comes from. The credit quality looks good right now, I'll give them that. Charge-offs are around 2.6%, which is solid. The average borrower makes $157,000 per year with a FICO score of 745. These aren't risky subprime borrowers. However, and this is critical, we haven't seen this loan book tested in a real recession yet. What happens if unemployment spikes to 6-7%? Even high-quality borrowers start missing payments when they lose their jobs. That's when charge-offs could jump from 2.6% to 4 to 5%, maybe higher. And if that happens, those impressive earnings projections for 2026 go out the window. Let me compare this against something that matters, which is how it moves relative to the market. The beta here is around 1.93. That means when the market moves 1%, this stock typically moves 1.93%, almost double the market volatility. Now, if we're in a bull market and the economy is expanding, that's fantastic. You get amplified gains. But what about the flip side? If the market drops 10%, this could easily drop 19%. That's the trade-off we're accepting at these levels. Am I comfortable with that level of volatility given the current valuation? That's the question I keep asking myself. Here's something most people aren't considering carefully enough. The Federal Reserve's rate policy directly impacts this business in 2 ways. First, lending margins get squeezed when rates are high because borrowing costs increase. Second, and more importantly, when rates are elevated, refinancing activity collapses. Right now, mortgage rates are still around 6.57%. That's keeping the home loan business under pressure. If rates drop to 5-6% next year, we could see explosive growth in mortgage originations. That's a potential catalyst. But what if the Fed keeps rates higher for longer? What if inflation reignites and we don't get those rate cuts everyone's expecting? Then we're stuck with muted lending volume while paying 52x earnings for it. Let me synthesize this. At 29.24, I'm sitting in an uncomfortable spot. The company is executing well, growing members at 35% annually, and finally turning profitable. Those are all positives. However, I'm paying 52x earnings for a lending business that's never been tested in a recession, while sitting 10% from all-time highs after a 101% year-to-date run. If I'm already in this position, here's what I'm doing. I'm taking 20 to 30% of my position off the table right here. Why? Because the risk reward has shifted. I've made 100% gains. Locking in some profits isn't being fearful, it's being smart. Let's say the stock runs to $35. I'll miss out on some gains, sure. but if it drops to $24, I'll be grateful I took something off. Now, if I don't own it yet, am I buying here at $29? Absolutely not. I'm waiting. Where am I waiting? I want to see $26, maybe $25. That's where institutions were accumulating heavily, and that's where I'd feel comfortable with the risk-reward trade-off. The next major catalyst is Q4 earnings in late January 2026. If management reports another strong quarter and raises guidance again, that could push us toward $33 to $35. That's the bull case. But if they miss, or even worse, if they guide conservatively for 2026, citing economic uncertainty, we could see a quick move down to 24 to 25. Given that binary outcome, do I want to hold a full position into that earnings report at 52 times earnings? That's a personal decision, but for me, the answer is no. I'd rather take some chips off the table now, wait for clarity, and potentially buy back cheaper if the sell-off happens. For those who understand options, here's an interesting play. Instead of buying shares at $29, consider selling cash-secured puts at the $25 strike for January expiration. You're getting paid premium to potentially buy the stock at $25, which is roughly 15% below current levels. If we do get that pullback I'm expecting, you're buying at a price I actually like. If we don't, you keep the premium. That's how I'd play this if I wanted exposure without chasing current prices. Look, this is a quality company with strong execution. I'm not bearish on the long-term story. But at $29.24 after a 101% gain trading at 52 times earnings, I'm cautious. The market is pricing in perfection. One stumble and we're back at 24 to 25 fast. If you're sitting on big gains, take some profits. If you're watching from the sideline, be patient. Wait for a better entry. The stock will give you that opportunity. It always does after runs like this. The strategic vision is clear. Transform from a lending-focused company to a diversified financial platform where 50% or more of revenue comes from capital-light, fee-based businesses. They're already at 43% fee-based revenue as of Q3. Management is also betting big on crypto integration. They just became the first nationally chartered bank to offer crypto trading. If the regulatory environment opens up under the Trump administration, Noto has indicated they'll expand into crypto clearing, asset-backed lending, and possibly even a stablecoin. When it comes to my rating, SoFi Bank is currently trading at a forward PE of about 52 times based on 2025 earnings estimates. That's expensive. For context, traditional banks like Bank of America trade at 10 to 12 times earnings. Even JP Morgan, the best run bank in America, trades at 12 to 15 times, so you're paying a 4x premium for SoFi versus elite traditional banks. But here's why that might be justified. SoFi Bank is growing revenue at 35-38% year over year. Traditional banks are growing at 3-5%. SoFi is in the early innings of monetizing a member base that's growing 35% annually. The lifetime value of each customer is expanding as they add more products per member. Cross-sell rates hit 40% in Q3, the highest since 2022. When I look at the PEG ratio, price to earnings divided by growth rate, I get about 2.7. Generally, anything under 1.0 is considered undervalued, 1.0, 2.0 is fairly valued, and above 2.0 is expensive. So at 2.7, SoFi is pricing in a lot of growth. But if they execute on Noto's vision and hit that 20-25% EPS growth through 2029, this PEG ratio comes down to more reasonable levels. The price to sales ratio is about 10.7x, which is rich but not insane for a high-growth fintech that's now profitable. Compare that to early-stage fintechs burning cash, and suddenly SoFi's profitability premium makes more sense. I am keeping my same rating of yesterday, not much changes. I'm giving SoFi a hold rating with a strong buy zone and a reduced zone clearly defined. Current price $28.50 is in the hold zone. Here's my breakdown. Strong buy zone, $24.00 to $26.50. If SoFi pulls back to this range, I would be aggressively accumulating for long-term positions. This represents a 10-15% pullback from current levels and would offer an excellent risk-reward entry. Buy zone 2650 to 2750. Still attractive for building positions, especially on dips. This is where institutional buying has been strongest. Hold zone 2750 to $30. Current price of $28.50 sits here. At these levels, I'm not selling if I'm already in, but I'm not adding aggressively either. I'm watching and waiting. Reduce zone 30 USD to 33 USD. If we push back to the all-time high around 32.73, I'd be taking some profits, especially on short-term trading positions. Trim 10-20% of holdings to lock in gains. Sell zone above $33 hours. If SoFi breaks above $33 without new fundamental catalysts, that's momentum-driven euphoria. I'd be taking significant profits, maybe 30-40% of my position, and waiting for a better re-entry. My 12-month price target is 35 wars to 38 wars, assuming they execute on Q4 2025 and Q1 2026 earnings. That's about 20-25% upside from current levels. But I think we'll see volatility getting there. I'm expecting a pullback to $26 to $27 before year end as some tax loss selling and profit taking kick in. The key catalysts I'm watching are Q4 earnings on January 26, 2026. If they beat and raise again, that's the signal for the next leg up. Crypto trading adoption metrics. If they can show strong uptake, that validates the platform expansion thesis. Any news on student loan privatization? If Trump moves forward with privatizing federal student loans, SoFi is positioned to be a major beneficiary. Mortgage market momentum. If rates drop below 6%, their home loan business could explode in 2026. The risks I'm monitoring closely are valuation compression if growth slows. At 52x forward earnings, there's no room for error. Credit quality deterioration. If we hit a recession in 2026, their high-quality borrower base could start showing stress. Competition intensifying. Traditional banks are waking up and other fintechs are nipping at their heels. Regulatory headwinds. As they get bigger, regulatory scrutiny increases. My strategy for investors depends on your time horizon. If you're a long-term investor with a 3 to 5 year time horizon, I think SoFi is a core holding in the fintech transformation theme. Hold what you have, add on dips to 26 to 27 and plan to ride this to 50 plus by 2027. If you're a swing trader with a 3-6 month horizon, I'd wait for a pullback to 26 to 27 before entering. Current levels don't offer great risk reward for short-term trades. If you're already in and sitting on big gains, take 10-20% profits here, especially if you bought under $20. Lock in some gains, let the rest ride. For options traders, I'm seeing interesting premium in selling cash secured puts at the $25 strike for December or January expiration. You get paid to wait for a dip, and if assigned, you're buying at levels I consider attractive. My final verdict, this company is a legitimate fintech disruptor with visionary management, strong execution, and a massive market opportunity. The stock is fairly valued to slightly expensive at current levels, but if they deliver on the roadmap Noto has laid out, there's significant upside over the next 12-24 months. I'm not calling this overvalued, but I'm saying it's priced for perfection. Wait for weakness to add, hold existing positions, and stay focused on the long-term transformation story. This is a stock you want to own through 2026 and beyond, but timing your entry matters. Patience will be rewarded. Thanks for watching, subscribe, and I'll see you tomorrow for our next daily analysis.